everyone. We are here today to report on Chapter 11, Capital Budgeting, specifically focusing on the Profitability Index examples found on pages 385 to 387 of our textbook. Our discussion will cover two illustrative examples, letter D, which is about the Cap Company's machine replacement decision, and letter E, which is about Chelsea's investment analysis. So karon guys, mag-report ta karon bahin sa capital budgeting. Pila ka money ang angay i-invest o kung makita ba ang maayong kita gikan sa isa ka investment. Now let's start the discussion. But first, we have to read muna the learning objectives. Before we begin, let us first look at our learning objectives for this report. By the end of this presentation, we should be able to define capital budgeting and explain why it matters. Second, apply the key techniques, NPV, IRR, and profitability index to evaluate investments. Next is correctly compute the net investment and annual cash flow net of tax as shown in example D. Next is determine the required investment and IRR as demonstrated in E. And most importantly, interpret our results to make correct, accept, or reject decisions. So what is capital budgeting? Now, capital budgeting is the process of evaluating long-term investment decisions to determine their profitability and feasibility. In simple terms, guys, it helps a business decide whether a big investment like buying new equipment or starting a new project is worth it. Businesses rely on this process to make sure that the money they spend will generate value over time. The core principle behind this is the time value of money, which tells us that money available today is more valuable than the same amount of money in the future because money today can earn interest or be invested. So in Bisaya pa guys, that ang time value of money nagapasabot nga ang kwarta karon mas bililhon kaysa sa kwarta karon pwede pa ganing magamit mamuhunan o makakita og interest. So this report focuses on NPV, Profitability Index, and IRR, three widely used tools in real-world financial decision-making illustrated through examples D and E. So let us now review the four key concepts we will be using throughout this report. So first, the time value of money. As we mentioned, money today is more valuable than money in the future. This is why we need to discount future cash flows before comparing them to a current investment. Second, the net present value or NPV. NPV measures the difference between the present value of cash inflows and outflows. If the result is positive, the project. If it is negative, then we reject it. Kung mas dako ang value sa maabot ka cash kaysa sa gasto karon, positive ang NPV, meaning maayo ang investment. Third, the internal rate of return or IRR. This is the actual percentage return the project generates. If the IRR is higher than the required rate of return, we accept the project. So fourth, the profitability index or PI. This measures the ratio of benefits to cost. A PI greater than 1 means the investment is desirable because you are getting more than 1 peso of value for every peso invested. So in Bisaya pa guys, kung ang PI is greater than 1, meaning ang kwarta nga imong gigasto makakita og mas dakong kita. So meaning it is maayo ang investment. Move on the actual illustrative examples. We have two examples to discuss today. Example D involves the Cap Company, which is deciding whether to replace an old machine with a new one. We will compute the net investment, annual cash flow, net of tax, and the net present value. On example E naman involves Chelsea, who is evaluating a project with 4 annual payments. We will use the profitability index to find the required investment and then compute the internal rate of return. Now let us now read the problem for example D. Cap Company is considering replacing machine A with machine B. Machine B will cost 150,000 pesos and will result in annual savings of 40,000 before tax because of the expected increase B. Machine B will cost 150,000 pesos and will result in annual savings of 40,000 before tax because of the expected increase in operating efficiency. Machine B has an estimated useful life of 10 years and a salvage value of 10,000 pesos. Machine A naman has a book value of 16,000 pesos and a disposal value of 20,000 pesos now. Straight line depreciation is used and the company has an average income tax rate of 35%. The minimum desired rate of return on this investment is 20%. The present value of an ordinary annuity for 10 periods at 20% is 4.192. The present value of 1 peso for 10 periods at 20% is 0.162. So in Bisaya pa guys, ang problema kay angay ba nga i-replace sa company ang ilang machine A o bago ang machine B nga 150,000 ang kantidad nga makakita og 40,000 pesos matag tuig nga savings. Now we are required to find the net investment, the annual cash flow net of tax, and third, the net present value. So let's compute the net investment. So for step 1, we need to compute the net investment. What is being computed here? So the net investment is the actual cash the company must pay out of its own pocket to get the new machine, after considering the proceeds from selling the old machine and the tax on that sale. So the formula is net investment is equal to cost of new machine minus proceeds from old machine plus tax on gain. So in Bisaya pa guys, ang net investment kay dili lang ang presyo sa bagong makina. Angay usab atong ididak ang kwarta nga nakuha gikan sa pagbaligya sa daan nga makina or machine ug i-add ang tax nga gibayad sa kita niya to. So let us plug in the numbers. The cost of machine B is 150,000. We subtract the proceeds from selling machine. We subtract the proceeds from selling machine A, which is 20,000 pesos. Then we add the tax on the gain. Machine A was sold for 20,000, but its book value is 16,000 pesos. So the gain is 4,000 at a 35% tax rate. So the tax is 1,400 pesos. Therefore, the net investment is equal to 150,000 minus 20,000 plus 1,400 is equal to 131,400. So the final answer is the net investment is equal to 131,400. So ang tinuod nga gasto sa company para sa bagong machine kay 131,400 dili ang 150,000 kay since na may gidida ka kwarta gikan sa daan ng machine. Alright, for the next step or the step 2, we compute the annual cash flow net of tax. What are we computing here? So this is how much actual cash in the company receives each year after paying income tax. Even though the machine was saves 40,000 a year, the company still needs to pay tax on the taxable income. So in Bisaya pa guys, ang annual cash flow net of tax kay ang tinuod na cash nga madawat sa company matag tuig human na mabayaran ng income tax. First, we compute the annual depreciation using the straight line method. 150,000 minus 10,000 or the salvage value divided by 10 years is equal to 14,000 per year. Then, the annual savings of 40,000 minus depreciation of 14,000 is equal to taxable net income of 26,000. So, ang tax is equal to 26,000 times 35% is equal to 9,100. So, finally, the annual cash savings of 40,000 minus income tax of 9,100 is equal to annual cash flow net of tax 30,900. So, the final answer, annual cash flow net of tax is equal to 30,900 pesos. So, matag tuig, ang bank accounts sa company musaka og 30,900 tungod sa bagong machine. Kana human na bayari ang tax or after the tax is paid. So this means over the 10-year life of the machine, the total cash received would be 300,000 or 309,000. For step 3 naman, we now compute the net present value or NPV. What are we computing here? So the NPV tells us whether the total value of all future cash benefits expressed in today's money is greater than or less than the cost of the investment. Ang NPV nagkuha sa tanan nga maabot na cash. So ikuha ang ilang kantidad karon and they compare sa gasto sa investment. Kung mas dako ang benefits, positive ang NPV, which means maayo siya. Kung mas dako ang gasto o negative siya, meaning dili siya maayo for investment. Now let us move on to example E, the Chelsea investment. Chelsea has an opportunity to invest in a project that will yield 4 annual payments of 12,000 with no salvage value. The first payment will be received in exactly 1 year. On lower risk projects of his type, Chelsea requires a return of 6%. Based on this requirement, the project generates a profitability index of 1.03953. So, ang problem kay, si Chelsea gusto mag-invest. Makadawat siya og 12,000 every year sulod sa 4 years. Now, gusto niya nga ang iyang kita at least 6% every year. So, the PI na gihatag is 1.03953. Now, we are required to find how much is the required investment and B, what is the internal rate of return. For step 1, we compute the present value of the annual cash flow. What is being computed here? So we need to find how much 12,000 per year for 4 years is worth in today's money using the 6% discount rate. Kung magdawat ta og 12,000 every year sulod sa 4 years, pila ba ang kantidad niya adto karon gamit ang 6% discount rate? So, mao ka na ang atong makuha diri na report. So the formula is PV is equal to annual cash inflow times PV annuity factor or 6% in 4 years. Next is the PV. PV is equal to 12,000 times 3.4651 is equal to 41,581.20. So the result is the present value of cash flows is equal to 41,581.20. So, ang 4,000 or ang 41,581.20 mao ang kantidad karon sa tanan nilang 12,000 nga maabot sulod sa 4 years. So, mao ni ang atong gamiton nga sunod na step. For step 2, we now find the required initial investment using the profitability index. The profitability index formula is PI is equal to PV of cash flows divided by initial investment. Since we already know the PV or the 41,581.20 and the PI which is the 1.03953, we can arrange to solve for the initial investment. So, ang PI nagapasabot para sa matag piso nga i-invest, pila ang makuha nimo. Kung ang PI is equal to 1.03953, meaning, para sa matag piso nga i-invest, makakuha ka o 1.03953 nga value. So, mao nga mas dako ang PI, mas maayo. And initial investment is equal to PV divided by PI. So, i-divide nato itong mga numbers kaganina, which is the 41,581.20 divided by 1.03953 is equal to 40,000. And the final answer, required investment is equal to 40,000. So, si Chelsea, kinahanglan mag-invest og 40,000 karon para makadawat og 12,000 every year sulod sa 4 years. Since ang PI is moto siya, which is greater than 1, this confirms the project is desirable. So, Chelsea gets more value than what she invests. For step 3 naman, so we compute the internal rate of return or the IRR of the project. What is being computed here? So, the IRR is the actual percentage return this project generates. We want to know if it is higher than Chelsea's required 6% return. So, IRR, mao ang tinuod nga rate of return sa proyekto. Kung ang IRR mas dako sa 6%, so maayo, so pwede siya i-accept. Kung upo sa 6%, dili, meaning pwede siya i-reject ang requirement. Let us now summarize the results for example B. Now, Chelsea needs to invest 40,000 today. The project will give her 12,000 per year for 4 years. The profitability index is 1.03953, which is greater than 1, confirming the investment is desirable. So, the IRR is approximately 7.72%, which is the higher than her required return of 6%. So, duha ka indicator ang nagsabot nga maayo ang investment ni Chelsea. So, first, ang PI mas dako sa 1. And second, ang IRR mas dako sa iyang required rate of return. So, mao ka na i-accept ang project. What does this mean? The project earns 1.72%, more than what Chelsea requires. That extra return creates additional value for her. So, the decision is Chelsea should invest both PI is greater than 1 and IRR is greater than the required rate confirms this is a profitable project. Out negative at only 247. Some might think this is too small to matter, But in capital budgeting, any negative NPV means the project earns less than the required return. Even a small loss destroys value, so the decision must always be based on objective numbers. Bisan gamay lang ang negatibo sa NPV, dili ka na angay i-ignore. Nagapasabot ka na nga dili makabot sa investment ang required return sa company. For example, the IRR of 7.72 exceeds Chelsea's 6% requirement. So this shows us that the IRR rule is simple and powerful. If the actual return is higher than what you require, accept. If lower naman, reject. Let us now summarize the results for example E. Now, Chelsea needs to invest 40,000 today. The project will give her 12,000 per year for 4 years. The profitability index is 1.03953, which is greater than 1, confirming the investment is desirable. So the IRR is approximately 7.72%, which is the higher than her required return of 6%. So duha ka indicator ang nagsabot nga maayo ang investment ni Chelsea. So first, ang PI mas dako sa 1, and second, ang IRR mas dako sa iyang required rate of return. So mao ka na i-accept ang project. What does this mean? The project earns 1.72%, more than what Chelsea requires. That extra return creates additional value for her. So the decision is Chelsea should invest both PI is greater than 1 and IRR is greater than the required rate confirms this is a profitable project. So after studying both examples, we can draw some important lessons about capital budgeting. Out negative at only 247. Some might think this is too small to matter, but in capital budgeting, any negative NPV means the project earns less than the required return. Even a small loss destroys value, so the decision must always be based on objective numbers. Nabisan gamay lang ang negatibo sa NPV, dili ka na angay i-ignore. Nagapasabot ka na nga dili makabot sa investment ang required return sa company. For example, E, the IRR of 7.72 exceeds Chelsea's 6% requirement. So this shows us that the IRR rule is simple and powerful. R was approximately 7.72%, and the profitability index was 1.03953, which is greater than 1. So based on this, the decision is to accept. Chelsea should invest because the project exceeds her requested 6% return. So ang example E, ang IRR daw ang PI nagpakita ng maayong investment ni Chelsea. So i-accept na to siya. And the key takeaway from this report is that the NPV and IRR are powerful tools in capital budgeting. A positive NPV or an IRR higher than the required returns means the project is good. A negative NPV naman or an IRR lower than the required return means the project is bad. These methods help businesses and individuals ensure their money is working for them. And that concludes my report. Thank you for listening.